Welcome to the channel. My name's Jodie Nutt and I'm a popular investor over on eToro. You can find me over there by searching Jodie Slaney. For some reason, they won't let me change my username to my name since I got married, so we have to keep working with that. In this video, we're going to take a quick look at the macro data for the week, as well as some other pressing news, and look at some charts that I think are worth a little sneaky peek. Monday, not too much exciting there. Not really going to pick at that data. Tuesday, again, not too much exciting. We have a little bit of home data. Red book's up a bit, nothing too bad. I've spoken about it before. Manufacturing, not particularly interested in those numbers given that it's not America's strong suit right now, but I do like to look at the services data. If we take a little peek, this has been a nice little trend upwards. Obviously, we had this little blip here. Hopefully, that's just a one-off and we can continue to be in expansion for that. If we look back historically, getting between 0 and 25 is definitely where we want to be seen to be heading, and that does look like it seems to be coming to fruition. So let's hope that continues. On Tuesday as well, we had the money supply. This is excellent. Lots of liquidity coming. Can't complain about that. And if we look at the longer time frame, we're definitely getting a curl back up. This is good. This is great for the markets and definitely great for risk on assets. Wednesday's data, we had more mortgage data. The market's still not really paying much attention to this, and there's not too much exciting to look at for the moment. The only other data that I was really interested in was the S&P Global bits and bobs. Manufacturing came in okay, a little bit weaker, but nothing alarming. Services I did like was a little bit up. Can't complain about that. And the composite PMI flash was also up. So that's nicely in expansion as well if we have a quick look at that one. It's a fairly nice trend going on here, and if we put it out to longer, we can see it's back, historically where we'd like to see that. Taking a look at Thursday, we can see we had some important bits of data with the durable goods and the GDP growth. That is the advanced number though. That is higher than we would have liked to see, so it's probably going to get revised down, but it might be a little bit early to say that. The durable goods as well, if we take a look at that did come in quite low, not ideal. Minus 6.6%, but if we put it out on the longer time frame, it's still kind of within the ranges that it likes to flip-flop around in, but we don't really want to see it contract lower than that. Manufacturing has taken a hit, but hopefully that can roll back up. Other data for the day was jobs data. For the most part, nothing too wild. They're kind of between consensus and forecast for the most part. Slightly lower. But we did get core PCE prices lower quarter over quarter. Again, that's advanced. And GDP sales quarter over quarter 2%, which was lower than forecast. Mainly, I think, for the big picture. The data is a little bit mixed today. The strong GDP and the okay jobs data isn't necessarily good for the cut story that everyone's building. But the cheaper goods is definitely good for killing inflation. Taking a look at Friday, I'm surprised the market didn't sell off that much on these news. They came in a little bit hot. Core PCE price index month over month was up 0.1%. So it came in at 0.2. Personal income was also lower, which wasn't ideal. Although arguably it's good for inflation if people don't get paid more, but given the inflation that has already eaten away at a lot of stuff, they probably do need to be earning more money to be able to spend more money. So it's a bit of a situation there. Personal spending month over month, pretty flat. I did want to point out that if we look into these numbers, the core PCE price index, it's not as bad as it really looks. I mean, it's not great, but it's not terrible. I did find a better chart to show you the core PCE inflation. It's just a little bit more detailed, and then when we layer over that the year over year that we've got, it's still trending down. So it looks a lot better when you look at it like this way. So just because looking at the data one way made it look a bit rough, I'm still pretty happy with this data. Month over month, the trend is still coming down here. So I can't really complain too much about it. So I'm glad the market didn't overreact on that initial look at the data. The main thing I think is that this data print I don't think changes too much of the probabilities of getting the rate cut in September, I think that's still on the cards. Containerized freight, it's not come down a whole lot, but it's not going up, so silver lining and all that. But that's been a bit of a worry for a while. This eventually will make its way down the supply chain, so we do want to see this stock coming back down again. The dollar hasn't done too much this week. It's been pretty flat, actually. Given the events going on, it's quite a surprise, actually. I thought it'd be at least doing something, but I'm glad to see it's still under this bull market band. That has now turned into support, so that's great confirmation there. I do think we might get more downside on this one, which is good because this needs to come down for risk on assets and whatnot to run. So I'm happy about that. We can also take a quick look at oil. Loving this. We had a pretty confident break below the bull market band. It did have a bearish tilt to it, and we talked the last few weeks about there's a lot of resistance confluence in this area. It was going to make it really hard for oil to break higher. I think a lot of the driver here as well will be obviously Trump. He wants to drill more, and there's the expectation now that he's going to win the election. So I think that's got to be one of the key driving forces here. We are now below the golden Fibonacci, which is great. That's going to be tough to break back over, especially given the force that it went through with. I think the next sticking point for this one's probably going to be where this green trend line meets this purple. And then that's my long-term target that I had open will be hit. I actually think we could break below this one and see maybe back under the 70s. I don't know. We'll have to wait and see. Looking at commodities, we can see lithium had a pretty flat week. I'll take flat. That's still going to be great for Tesla. I mean, they're getting a nice fat discount on all the lithium. Having a quick look at agricultural again, we can see cocoa is not having a great time. That's still flying. Sucks if you love chocolate as much as I do. Coffee has started to come down this week, which I think a lot of people will be happy about, but it's still quite spicy. Other things that are still spicy, butter still sticking, but that was a bit of a terrible pun, really, wasn't it? Taking a look at the CME FedWatch tool, the upcoming meeting on the 31st, that's got a 95.9% chance of no change, which should prevent the market from throwing its dummy out the pram a little bit, but a lot of the volatility can come from JP's remarks. I'm not expecting him to change his tune much, but be cautious. The commentary after the actual announcement is normally where the action happens, especially when people get to asking him dumb questions. So we'll see how that goes. The meeting after that on the 18th, we do see a little bit of a drop here down to 87.7%. Now, that's not because people are less confident of getting a cut. It's actually because 11.9% expect there to be a larger cut. So we'll keep an eye on that, see how that goes. The US daily Truflation rate has absolutely fallen off a cliff again. I thought we might get more of a bounce back, to be honest, but it's now sitting at 1.65%, much lower than the government's current number. Primarily, I think that's because this is more of an accurate representation of where things currently are. I think the government data is a little bit lagging. It's definitely helpful. If you want to see why I like this particular metric, you can find out an explanation of that on my website at www.thecraftytrader.com. So that might be pretty helpful for you. It's got a link on where to find it as well. Taking a cursory glance over the fear and greed indexes, the market's still positioned neutral, which is impressive. I think really a lot of people are saying it's the end of the world. I don't think that's the case. The numbers are saying otherwise. Crypto fear and greed, it's now in greed, but not overly so. It's definitely a lot more that we can go on this one. It feels like a pop's coming, but it could be wrong. Who knows? Looking at some other market data, we've got hedge funds boost bullish wages, and we can see on this chart they are loading the boat with gold. Not particularly sure why. I don't know what they can see that we can't see. I mean, they have been wrong on being short in the market for quite a long time and being wrong about it. So we'll see. I think the contrarians on this will probably do quite well. I don't really like gold. I think it's had its day. If you want it for shiny jewelry, that's fine. But as a hedge, not my cup of tea. I also wanted to talk a little bit about small caps. There's been a bit of a transition lately in the market. I know it doesn't look on the face of this chart here that small caps have done really well, but the main thing is they've held their ground while other indexes have started to slide. So we're definitely seeing a bit of rotation, some selling off of the big boys, definitely happening in the SPY and the QQQ as well. So that makes me happy. A lot of my portfolio is geared towards this rotation, so I'm very excited. I'm not specifically in a lot of individual small cap companies. However, I am in the leveraged index, the TNA, which should do very well as this continues to expand in the coming months. Definitely when we get rate cuts, we should see a boom here as well as people try to front run those price rises. As well as that, the TMF, I'm starting to build more into that position. I've had it for a while. I did sell out of a large chunk of it. I just got my timing a bit wrong, but I think now is a good time to start loading into this one. As well as that, I'm starting to look more into property companies. A lot of the companies I'm interested in aren't on eToro, which sucks. So I'm probably going to have to open those in another portfolio. I might put on there which ones, but I'm not sure yet. Let me have to think about that. An interesting stat that I found as well. It's probably absolutely useless information, but I love useless information. The Russell 2000 was up more than 10% in 10 days. 86% of the time that happens, it results in a further 27% gain in the following year. I did put a little disclaimer there saying that it was pretty much useless, but it is a bit of nice confirmation bias there for you if that's your cup of tea. Moving on, we do have a little look at the expectation for EPS growth. We look down here at earnings. Sorry, this actual zoom feature is a bit annoying on this one I'm trying to show you. But we have a lot of flatness here, and then this is what I'm interested in. I'm very excited to see this happen in reality. I hope a lot of people aren't just sticking in the big boys. I think now's the time to start trimming a little bit of your gains and at least rotating a small percentage of your portfolio. That's not financial advice, but it's what I'm doing. It's what I've been doing. I rode the big caps last year. Yes, my timing's been a little bit early by about 6 months, but I don't think I'm wrong. I hope I'm not wrong, and I hope this continues. I've been a little bit busy this week, so I'm a little bit behind with my postings, but I have taken the liberty of stealing some of Maru 2021's data posts. I'm sure he'll be thrilled about that. I'll have a good laugh. I'm sure I'll get a text about it. Just really wanted to show that the money market funds have seen a lot of outflow. That's very exciting. That's more liquidity coming to the market, and you can't hate that, especially if you're in more of the risk on stocks, because guess where that money's going to go? The second point he makes is a bit of a political one. I don't want to go too much in it, but he does say the Trump victory remains favourable. The odds have slimmed a little bit, but my main concern is that any chance of Kamala coming in is terrible. I mean, Trump's not great and Biden wasn't great, but some of the things I'm seeing from Kamala are questionable. She seems to talk before she thinks, and she doesn't really understand much of anything, as far as I can tell. But I'm happy to be proven otherwise. I'm not super into American politics as far as actual individual people go. I just really want what's best for everyone. But I mean, in the UK, I can't say we're doing much of a better job either. So life's a bit rough. The third point he makes is that 34% of the SPX 500 is due to report earnings this week. Now that's going to cause some rather large volatility, I think. So far, we've seen a lot of stocks sell off, mostly related to guidance and prices just being so run up that they can't justify those rates. We're probably going to see more of that, but that does leave room for some companies to come and steal the show. I haven't seen much of that lately, so hopefully we'll see something exciting. It's been pretty boring so far. The last talking point that I've stolen from him is that the 2Q is expected to be the first EPS growth quarter for the other 493 companies in the index, which is very exciting for anyone that's really focused on this rotation happening. I think I've mentioned it earlier in this video that I think now is the time when you probably need to be expanding your options and looking at something else that's not a mega cap for your portfolio. You can always rotate back to them, but at least taking a little bit of risk off the table is probably advisable here. That's not financial advice, of course, but that is what I'm doing, and it's what quite a few other people are doing. So it's definitely something to be aware of, at least so you know while your mega cap positions are probably going to start sliding a little bit. I mean, they already have a little bit, so that could stop, but it could continue. There's plenty of money on the sidelines that can still come in, so it doesn't necessarily mean that they have to continue to sell off, but it does mean there are much lower hanging fruit available right now. I haven't updated too much content on the website this week. I've been a little busy, as I've said a few times. I have been doing the daily YouTube videos, though, for my core holdings. If you want to check me out on YouTube, you can do that. I'm still working on the Tesla earnings update. I'm about halfway done with that. I did think about doing a video just to make it faster, but I've been so busy with these videos, and I've got a couple more that I'm planning to make that I just haven't had the time. Turns out I think I have too many projects on the go and too many hobbies and too much going on. So hopefully time management will be a little bit better and I can start getting a bit more content onto the website for you all and being a little bit more active back on eToro again. But if you found this useful, give me a like, share and subscribe, and I hope we'll see you next time.